In July of 2015, Wells Fargo stood atop American banking. The company's market capitalization reached $301.6 billion, dollars, the highest valuation of any bank in the world. Investors saw a titan of stability and profit. CEO John Stumpf appeared on CNBC and CNBC, touting the bank's cross-selling strategy as the future of retail banking. But beneath the polished quarterly earnings reports and shareholder presentations, something had rotted in the institution's foundation. Between 2009 and 2016, Wells Fargo employees created 3.5 million fraudulent customer accounts. Savings accounts opened without authorization. Credit cards issued to people who never applied. Customers charged fees and interest on money they never borrowed. When the bank's collapse came, not in stock price but in public trust, it revealed a corporate culture so perverse that it punished truth-telling and rewarded deception. This is the story of Wells Fargo. Wells Fargo's roots ran deep into American history. Founded in 1852 by Henry Wells and William Fargo as an express mail company, it evolved into a financial institution woven into the nation's economic infrastructure. For over 160 years, the bank had survived panics, wars, and recessions. The cross-selling strategy that would eventually destroy the company's reputation began in the late 1990s under CEO Richard Kovacevic. The idea seemed reasonable on its surface. If customers held multiple products, checking, savings, credit cards, mortgages, investment accounts, they became stickier, more profitable, more difficult to move to competitors. The target was straightforward. Managers set a goal of 8 products per customer. They called it going for great. By 2002, senior executives knew employees were fabricating accounts to hit those numbers. Internal documents from that year showed awareness at the highest levels. The unethical behavior was not a rogue operation limited to a few branches. It was systemic. The pressure from above flowed downward through the organization like water finding every crack. Branch managers faced quotas they could not reasonably meet through legitimate sales. They pushed subordinates to meet targets. Subordinates, caught between impossible demands and fear of termination, opened fake accounts. The fraud compounded over 14 years. By 2009, the scheme was in full motion. Customer service representatives opened deposit accounts without authorization. They transferred money between existing accounts to generate the appearance of activity. They submitted applications for credit products using Social Security numbers and personal information harvested from existing customer records. Customers discovered charges on statements for accounts they had never opened. Many did not immediately realize what had happened. Wells Fargo fired approximately 5,300 low-level employees during this period. The message was clear. Those who carried out the fraud faced termination, while those who designed the system that incentivized the fraud moved upward. A whistleblower named Bill Beto worked at a Wells Fargo branch and called the company's ethics hotline to report what he had observed. 8 days later, he was terminated. The official reason given was tardiness. The timing suggested otherwise. The bank's leadership moved to suppress information. Employees who raised concerns internally were marginalized. Those who contacted regulators faced retaliation. The institution developed a sophisticated capacity to deny, delay, and deflect scrutiny. The scandal became impossible to contain in 2015. Regulators began asking questions. The Los Angeles Times published an investigation into the fraudulent accounts. More customers came forward. The Federal Trade Commission opened an inquiry. The Consumer Financial Protection Bureau, established after the 2008 financial crisis specifically to prevent this type of behavior, launched a formal investigation. On September 8, 2016, the CFPB announced its findings. The agency issued a $185 million fine, the largest civil money penalty it had ever imposed on a bank. Wells Fargo had created 3.5 million unauthorized accounts and charged customers approximately $2.6 million in fees and interest they did not legitimately owe. 12 days later, on September 20, 2016, CEO John Stumpf testified before the Senate Banking Committee. This moment revealed the character of the institution's leadership. Senator Elizabeth Warren presented the facts with precision. Stumpf offered deflection and evasion. When Warren called the leadership of Wells Fargo gutless, the phrase captured something true about institutional cowardice. Stumpf claimed he was unaware of the fraud until the CFPB investigation revealed its scope. The claim was false. Internal documents showed executives discussing the problem years earlier. Stumpf himself received emails about customer complaints and branch investigations dating back to 2013. The Senate hearing became not an explanation, but an exposure of a leader unwilling to accept responsibility, of an organization that believed it could talk its way out of accountability. The public response was immediate and severe. Stumpf's reputation disintegrated. On October 12, 2016, he resigned as CEO. The bank clawed back $69 million in compensation from him. The amount was substantial. It was also insufficient to represent the damage caused. Carrie Tolstead, who led Wells Fargo's community banking division where the fraud originated, also departed. The bank clawed back $67 million from her. She remained silent while investigations proceeded. In February 2023, 5 years after the scandal's public exposure, Tolstead pleaded guilty to obstruction of justice for destroying documents related to the investigation. She had worked to hide evidence. The scandal revealed another dimension of the fraud that shocked even observers who thought they had absorbed the full scope. Wells Fargo's auto insurance division had issued policies to customers without their authorization, approximately 27,000 people. When customers missed insurance payments on loans they never knew about, the bank's processors repossessed their vehicles. People lost cars because of fraud committed by the institution holding their money. The financial penalties mounted. Each regulatory body that examined Wells Fargo's behavior imposed fines. State attorneys general pursued cases. The bank's legal costs climbed. Each settlement was announced as if it represented the final reckoning. Each one was followed by another discovery, another investigation, another fine. On February 2, 2018, the Federal Reserve took an unprecedented action. It imposed an asset cap on Wells Fargo. The bank would not be permitted to grow beyond $1.95 trillion in total assets. The cap would remain in place for 7 years, until June 2025, the longest regulatory sanction of its kind. The message was unmistakable. The institution had forfeited the right to expand. The punishment was not a single fine, but a structural constraint on future growth. For a bank that had built its entire strategy around cross-selling and growth, the asset cap was a form of institutional remission. Over the years that followed, regulators and the Justice Department continued investigating. In February 2020, the bank reached a $3 billion settlement with the Department of Justice and the Securities and Exchange Commission for fraud. In December 2022, the Consumer Financial Protection Bureau announced a $3.7 billion penalty. The total penalties imposed on Wells Fargo since 2016 exceeded $27.9 billion. What remains of the Wells Fargo scandal is not a simple story of individual corruption or momentary ethical lapse. The fraud persisted for 14 years, affected millions of customers, and operated with knowledge at senior executive levels. The bank did not stumble into misconduct. It constructed a system that made fraud the path of least resistance for employees facing impossible quotas. The institution then punished those at the bottom while protecting those at the top. The scandal revealed something deeper about American financial institutions and regulatory oversight. The fines, while substantial, came years after the harm was done. Most executives involved faced no criminal charges. Criminal accountability was limited. The bank survived, diminished but functioning, able to continue serving customers despite the breach of trust. The Wells Fargo fraud was neither a secret kept in darkness nor a sudden surprise. It was a betrayal conducted in plain sight, in branch after branch, affecting customer after customer, while the institution's leadership claimed ignorance or accepted responsibility without consequence. The bank that had endured for 164 years found that money and legal maneuvering could survive where integrity could not be recovered.